There's a moment markets reach where optimism and fear stop being the main drivers, and something much quieter takes over. Not headlines, not narratives, not sentiment. Just arithmetic doing what it always does over time. That's the phase we're entering now. Because over the next few years, the global financial system isn't really being tested by elections, inflation prints, or even whether rates get cut or not. It's being tested by time, by what happens when an enormous amount of debt reaches maturity and has to be rolled out into a world that no longer looks like the one it was created in. Starting in 2026, somewhere between $9 and $12 trillion of US government debt comes due and must be refinanced. Not paid off, not cancelled, replaced. And that refinancing won't happen in a world of near zero interest rates that shaped the last decade. It'll happen in a world where money once again has a visible price. That single shift matters far more than most people realise. Before we go any further, let me properly introduce myself and the channel, because it explains why we're even talking about this. I'm Paula, and this channel is about understanding how markets actually work underneath the noise. No hype, no predictions, not this asset is about to explode. We focus on structure, incentives, liquidity, and the plumbing that drives price over time. If you've ever felt like markets move first and the explanations come later, this channel exists to close that gap. Now, this is not a story about the United States running out of money. Sovereign governments don't work like households. Refinancing is normal. Debt is rolled by design. The real issue isn't whether refinancing can happen, it's what it costs to do it and who ultimately absorbs that cost. For most of the last decade, that cost barely mattered. Interest rates were suppressed for so long that borrowing felt almost frictionless. In real terms, money was close to free. That environment allowed debt levels to rise without interest expense feeling restrictive. It shaped fiscal policy, asset prices, and behaviour all at once. But cheap money doesn't remove debt. It just delays the bill. Debt has maturity dates. And when low-rate debt matures, it doesn't care about the world it was issued in. It has to be rolled into the world that exists at the time of refinancing. That's the challenge now facing the US Treasury. Not whether it can issue new debt, but how the system adjusts when that debt is rolled at materially higher rates. Here's what that looks like in practical terms. When Treasury debt matures, the Treasury issues new debt to replace it. That happens through constant auctions. Investors bid, yields clear where demand meets supply. If rates are higher than when the old debt was issued, interest expense rises automatically. No drama, no policy announcement, just arithmetic. Interest payments are not optional. They get paid before almost everything else. That means over time, a larger share of government cash flow is diverted towards servicing debt. And when that happens, flexibility elsewhere slowly shrinks. Often, issuance doesn't just replace principal, it expands, because higher interest costs themselves need to be financed. This is how refinancing cycles quietly grow without anyone standing at a podium explaining that they're doing so. Another pressure point is duration. Issuing short-term debt keeps costs lower today, but often increases how often the system has to come back to market. Issuing long-term debt locks in higher rates for decades. There's no painless option. Every choice shifts pressure somewhere else in the system. This is why the problem isn't too much debt in isolation. It's debt interacting with time and interest rates. Over recent years, the system has leaned heavily on short-term borrowing. Treasury bills were favoured because they were easy to sell and had natural buyers. That choice made sense tactically, but it shortened the clock. It increased rollover frequency. It turned what could have been a long, distant issue into a recurring one. Short-term borrowing doesn't reduce cost, it compresses time. When enough of that stacks up, you don't get a cliff edge. You get a refinancing cycle, a period where large volumes of debt have to be rolled under conditions that no longer resemble the past. This is where people often expect drama. What usually arrives instead is constraint. As refinancing accelerates at higher yields, capital gets absorbed. Treasuries compete more aggressively for cash, risk-free yield becomes a genuine alternative again, and behaviour across the system adjusts quietly. Liquidity doesn't disappear, it gets redirected. This is why markets don't respond immediately with crashes. They respond with repricing, with hesitation, with rotation, with volatility that doesn't resolve cleanly. The first signs don't show up in headlines. They show up in funding markets, in repo, in auction demand, in balance sheets becoming more selective. The plumbing tightens first. Prices follow later. Once liquidity tightens at the margin, everything downstream adjusts. Equity valuations become more sensitive to discount rates, particularly growth assets where future cash flows matter most. Housing affordability becomes constrained by financing costs. Even if supply doesn't collapse, credit markets begin repricing alternatives because lending to risk now has to compete with lending to the government. This is how refinancing cycles actually transmit into markets. Not as panic, but as gravity. Volatility tends to rise, not explosively, but structurally. Fewer straight line trends, more chop, more false starts. Narratives stop working as reliably because the environment no longer rewards simplicity. Now, this is where it becomes very real for households. Because households don't experience refinancing cycles as macro theory. They experience them through prices, credit, and behaviour. Housing is usually the first place people feel it. Mortgage rates don't collapse just because inflation cools. They stay elevated because government borrowing keeps competing for capital. That means affordability remains tight even if house prices don't fall dramatically. For many people, the frustration isn't falling prices, it's being locked out. Credit becomes more expensive across the board. Credit cards, car loans, personal loans, refinancing options. Households become more rate sensitive. Spending decisions become more cautious, not because people panic, but because the cost of borrowing is no longer negligible. Employment feels it next. Companies don't suddenly fire everyone, they pause. Hiring slows, expansion plans get delayed, wage growth cools. The labour market adjusts without a single defining moment. It feels like pressure rather than crisis. Savings behaviour changes too. For the first time in years, cash yields something meaningful. Low risk assets compete with speculation. That shifts household decision making. Risk taking becomes more selective. People are less willing to stretch just to keep up. This is important because it explains why periods like this feel psychologically heavy, even when nothing catastrophic is happening. Systems are adjusting, behaviour is changing, and that adjustment takes time. Crypto sits inside this environment, not outside it. Crypto is downstream of liquidity. When capital is abundant and cheap, risk appetite expands and narratives thrive. When capital has a visible price and liquidity is being absorbed elsewhere, crypto doesn't vanish, but it behaves differently. Moves become cyclical rather than trend-driven. Volatility becomes structural. Timing matters more than conviction. And historically, some of crypto's strongest phases have arrived after markets finish digesting a new liquidity regime, not before. This is why transactional periods are uncomfortable. People sense change, but they try to force outcome from slow processes. Refinancing cycles don't reward impatience, they reward understanding. So what does this actually mean for normal people day to day? It means we're moving away from an environment where liquidity quietly lifted everything. It means returns arrive in more uneven ways. It means doing nothing can sometimes be the most rational decision. And it means confusion is often a sign of transition, not failure. Should people be scared? No. Fear comes from surprise. Surprise comes from not understanding what's happening underneath the surface. This refinancing cycle isn't hidden. The schedule is public. The mechanics are well understood. What catches people out is how quietly it develops and how quickly markets adjust once the new constraints are accepted. With all this in mind, it's exactly why we built the Crypto Liftoff course. Not to sell predictions, not to promise shortcuts, and not to tell people what price is going to do next week. The goal was to give people a framework for understanding markets across cycles, how liquidity actually moves, how macro pressure transmits into different assets, and how to stay grounded when narratives shift faster than fundamentals. The benefit isn't excitement, it's clarity. Clarity allows you to make rational decisions when markets feel messy or directionless. It helps you avoid forcing trades just to feel productive. And it's how we make money across very different environments. Not by guessing direction, but by understanding structure. So whether you're completely new to trading or you've been around the markets for years, having a calm, structured approach is an advantage. Most people don't struggle because they lack information. They struggle because they don't have a framework that helps them filter what matters from what doesn't. The Crypto Liftoff course is simply the framework we use inside the Crypto Wolfpack. Not financial advice, not a promise of results. Just the structure we use to trade and manage risk in both bull and bear markets, without panic and without hype. And that brings us back to the bigger picture. A refinancing wall doesn't mean collapse. It means change. It means the system is adjusting to new constraints. And change doesn't have to be frightening if you understand the mechanics behind it. That's how we approach markets on this channel. Calmly, systematically, with an emphasis on understanding rather than noise. And if that way of thinking resonates with you, like the video and give me a subscribe to the channel. Thank you so much for watching, and I'll see you in the next one.